We don't want to import your cancer. Lehman Brothers has just died. The men in the room do not know it yet. They will know it in 7 hours. $639 billion in assets, $613 billion in debt, 28,000 employees, a 158-year-old bank, all of it gone in 72 hours, in a single weekend after the 4 most powerful men in American finance sat in one room and decided, implicitly, by exhaustion and absence of options, to let it die. What follows is not the story of a single fraud or a single villain. It is the story of an institutional decision to kill Lehman Brothers on Monday morning, and 24 hours later to rescue AIG for $182 billion. This is what it looks like when a country decides, in one weekend, that the rules of moral hazard apply to some banks, but not to others. In 1850, Henry Lehman opens a general store on Court Square in Montgomery, Alabama. His 2 younger brothers, Emmanuel and Meyer, join him within 4 years. The Lehman Brothers are immigrants. They are Jewish in the American South. They cannot get bank credit, so they barter. They take cotton from farmers in exchange for the goods on their shelves, and they sell the cotton in New Orleans for cash. By 1858, they have moved their headquarters to New York. For the next 150 years, Lehman Brothers will be one of the survivor firms of Wall Street. They survive the Civil War, despite being a Southern house. They survive the Great Depression. They survive the dot-com crash, the Enron scandal, the September 11th attacks 2 blocks from their headquarters. In 1994, the firm, which had been a subsidiary of American Express, is spun off as an independent investment bank under a new chief executive named Richard Severin Fuld Jr. People call him Dick. Inside Lehman, they call him the Gorilla. He is famous for his loyalty to the firm. He is also famous for his temper. He once said, on the record, about Lehman's short sellers, "I want to reach in, rip out their hearts, and eat them before they die." In a Wall Street that prides itself on a kind of clubbable composure, Dick Fuld is the outlier. He is hated. He is also, until 2008, very, very successful. By 2007, Lehman Brothers reports record revenue of $59 billion and net income of $4.2 billion. The stock peaks at $86 per share. Fuld personally is paid $484 million between 2000 and 2007. He is 58 years old. He believes the firm is unkillable. He is wrong. The reason is something that has been quietly happening on the lower floors of 745 7th Avenue since around 2001. Lehman has been loading its balance sheet with mortgage-backed securities and a derivative product called collateralized debt obligations, CDOs. They are bundles of home loans, including subprime loans. Lehman packages them, slices them into tranches, sells some, holds the most toxic ones for itself, and uses the rest as collateral to borrow more. By the end of 2007, Lehman is leveraged at 30-1. This means, for every dollar of equity capital, actual money the shareholders own, Lehman has $30 of obligations. If the value of the firm's assets falls even 3%, every shareholder is wiped out. The firm is, technically, insolvent. What makes this not look insolvent on quarterly reports is a thing called Repo 105. Repo 105 is a short-term repurchase agreement structured so that, on Lehman's books, it counts as a sale rather than a loan. For 7 to 10 days at the end of each financial quarter, Lehman moves $50 billion of assets off its balance sheet by selling them under a Repo 105, then buys them back the day the quarter ends and the audit is complete. The effect is to make Lehman's leverage ratio appear to drop from 13.9 to 12.1. It is an accounting trick. It is also a manipulation. It is not technically illegal under US GAAP, but it requires a legal opinion under UK law that no American firm will sign. So Lehman gets the opinion from Linklaters in London, executes the trades through its UK subsidiary, and books them in New York. Ernst & Young, Lehman's auditor, signs off on Repo 105 every quarter for years. In December 2010, the New York Attorney General will sue Ernst & Young for $150 million, alleging the firm substantially assisted a massive accounting fraud. Ernst & Young will settle in 2015 for $10 million without admitting wrongdoing. In March 2008, Bear Stearns, the smaller, scrappier investment bank, fails. The Federal Reserve, under Section 13(3) of the Federal Reserve Act, lends $30 billion to JP Morgan to absorb Bear's toxic assets. Wall Street watches and learns the wrong lesson. The lesson Wall Street learns is, the Fed will catch us. Dick Fuld learns it too. For the next 6 months, he refuses every overture to sell Lehman, from Warren Buffett, from Korea Development Bank, from Bank of America, at any price below what the stock currently trades at. He believes Paulson, who is Treasury Secretary, will not let Lehman fail. Paulson, after all, used to run Goldman Sachs. He is Wall Street. In June 2008, Lehman announces a second-quarter loss of $2.8 billion. It is the firm's first quarterly loss as a public company. Short sellers, who have been circling for months, taste blood. The stock falls 45% in a single month. On September 9, 2008, Korea Development Bank, Lehman's last credible buyer, withdraws from negotiations. The stock falls 42% in a single day. That Friday, September 12th, 42% in a day. Dick Fuld picks up the phone and calls Hank Paulson. Paulson listens. He does not promise anything. On Saturday morning, September 13th, Tim Geithner, the president of the New York Federal Reserve, convenes the most important meeting of the financial crisis. He summons the heads of every major Wall Street bank to the 13th floor conference room of 33 Liberty Street. They sit around a long mahogany table. Jamie Dimon of JP Morgan, Lloyd Blankfein of Goldman Sachs, John Mack of Morgan Stanley, John Thain of Merrill Lynch, Vikram Pandit of Citigroup, Bob Steele of Wachovia, Ken Lewis of Bank of America, Bob Diamond of Barclays Capital. They are 8 men. They are responsible collectively for the next 72 hours of the global financial system. Geithner walks to the whiteboard. He draws 3 columns. He calls them the 3 buckets. Then Hank Paulson, the Secretary of the Treasury, stands up. He says, in a sentence, he will spend the next 15 years trying to walk back. There will be no government money in this deal. The 8 CEOs read Lehman's books over Saturday afternoon. They read what is on the balance sheet. They also see what is not on the balance sheet, what Repo 105 has been hiding for years. Lloyd Blankfein turns to a colleague at one point and says quietly, "This place is fucked." By Saturday evening, the consortium plan, Bucket B, has collapsed. No bank is willing to write $1 billion check to bail out a competitor. Bucket A is the last hope. Bob Diamond, the American running Barclays Capital from London, wants Lehman. He has wanted Lehman for years. He sits in 33 Liberty most of Saturday night, on phones with his Barclays board in London, working through what the price would be. On Sunday morning, the surprise. Ken Lewis, who was supposed to be evaluating Lehman as a backup if Barclays could not close. instead announces that Bank of America is buying Merrill Lynch for $50 billion in a deal negotiated in entirety over the previous 48 hours. Merrill Lynch, the storied retail brokerage with 18,000 brokers, had been next in line to fail. Lewis chose Merrill. He did not choose Lehman. Bob Diamond is now the only buyer left. By Sunday afternoon, Diamond and the Barclays board have agreed on a price: $1.7 billion for Lehman's operations, with the Federal Reserve providing a backstop for the toxic CDO portfolio. The deal would also require the 8 other Wall Street CEOs in the room to share the toxic asset risk through a private financing facility. They agree, reluctantly. Paulson is in another room negotiating the Fed backstop. It seems possible that Lehman will survive. There is one remaining condition. Under UK securities law, Barclays cannot acquire a company the size of Lehman without an emergency vote of its shareholders, a vote that normally takes 30 days. To skip that vote, Barclays needs an explicit waiver from the UK Financial Services Authority, and that waiver requires the personal approval of Alistair Darling, the Chancellor of the Exchequer. It is now Sunday afternoon in New York. It is Sunday evening in London. The London markets will open in 12 hours. Darling does not have to think hard about this decision. The British banking system is itself fragile in September 2008. He has just spent 6 months stabilizing Northern Rock. If Barclays absorbs Lehman's toxic portfolio without a proper shareholder vote, the entire risk lands on British depositors. He has no obligation to American politicians on a Sunday evening. The call is forwarded to Bob Diamond, who is in 33 Liberty Street with Paulson and Geithner. It is approximately 9:30 p.m. Eastern Time, 2:30 a.m. London time. The answer is no. The line Diamond later remembers, the line that everybody in the room remembers, though no formal transcript exists, is from Darling himself. "We don't want to import your cancer." Diamond lowers the phone. He looks at Paulson. Paulson looks at Geithner. Geithner puts his head in his hands. There is no buyer. At 11 p.m. Sunday night, Dick Fuld places his last phone call as the chief executive of a solvent firm. He calls Hank Paulson. He begs for emergency access to the Federal Reserve discount window, a facility that, by Monday morning, will be opened for Goldman Sachs and Morgan Stanley, who are next in line to fail. Paulson says no. The reason he gives is, "I can't do it for legal reasons." 2 days later, the Federal Reserve will lend $85 billion to AIG under Section 13(3) of the Federal Reserve Act, the same legal authority that could have been used for Lehman. Tim Geithner will, years later, in his memoir, Stress Test, write that the Fed simply had no legal authority to save Lehman. The Examiner's report by Anton Valukas, filed in March 2010, will dispute that. So will Ben Bernanke, in a quieter way, in his memoir, The Courage to Act. Bernanke will write, "I would have done it differently." Inside the offices of Lehman Brothers at 745 7th Avenue, the lawyers from Valukas and Manges have been preparing a contingency Chapter 11 bankruptcy petition since Friday. At 1:45 a.m. on Monday, September 15, 2008, they file it in the United States Bankruptcy Court for the Southern District of New York. It is the largest bankruptcy in United States history. It will remain the largest bankruptcy in United States history. Asian markets open red. The Nikkei drops 4.7%. Hong Kong drops 5.4%. By the time the New York Stock Exchange opens at 9:30 a.m. on Monday, every credit default swap desk on Wall Street is repricing the global financial system in real time. The Dow Jones Industrial Average closes that Monday down 504 points, or 4.4%, the largest single-day point drop since the days after September 11, 2001. That afternoon, something happens that has not happened since 1994. The Reserve Primary Fund, a money market fund holding $785 million of Lehman commercial paper, breaks the buck. Its net asset value falls below $1 per share. Money market funds are supposed to be impossible to lose money in. $3 trillion of cash sitting in money market funds across the United States suddenly looks like it might evaporate. Treasury Secretary Hank Paulson watches the run begin. 24 hours after telling Dick Fuld that there is no government money for Lehman, Paulson is in the Oval Office, telling President Bush that the federal government needs $85 billion for AIG by close of business that day. The bailout will eventually total $182.3 billion in committed assistance, $112 billion from the Federal Reserve, $70 billion from Treasury through the Troubled Asset Relief Program. The peak actually disbursed reaches $141.8 billion in April 2009. By 2013, AIG repays it all. The American taxpayer makes a positive return of $22.7 billion on the rescue. Paulson's line, "There will be no government money," has lived, in real terms, for 36 hours. In March 2010, a Chicago lawyer named Anton Valukas, appointed by the bankruptcy court to investigate the failure, releases a 2,200-page autopsy of Lehman Brothers. The report is divided into 9 volumes. It runs to 110,000 pages of source documents in its appendices. Volume 3 contains the most quoted finding of the entire crisis, that Lehman, in the 8 quarters preceding its collapse, used Repo 105 and a related product called Repo 108 to move $50 billion off its balance sheet every quarter for the 7 to 10 days that mattered. Ernst & Young, the auditor, knew. The legal opinion came from Linklaters in London. The board of directors, the Valukas report finds, was not adequately informed. Nobody at Lehman top management is criminally prosecuted. The Securities and Exchange Commission opens an investigation into Dick Fuld. It is dismissed in 2010. The Department of Justice opens an investigation. It is closed in 2012. The New York Attorney General sues Ernst & Young in December 2010 for $150 million. The case is settled in 2015 for $10 million. Ernst & Young does not admit wrongdoing. The architects of the weekend write their memoirs. Ben Bernanke publishes The Courage to Act in 2015. Hank Paulson publishes On the Brink in 2010. Tim Geithner publishes Stress Test in 2014. Each book offers a slightly different account of who decided what and when and why Lehman specifically had to die. Dick Fuld, in 2015, gives his first public interview since the bankruptcy. He says, "I don't regret a thing." In July 2010, President Obama signs the Dodd-Frank Wall Street Reform and Consumer Protection Act. It runs to 848 pages. It creates the category of Systemically Important Financial Institution, SIFI, and an orderly liquidation authority so that no future bank failure will require a weekend of phone calls between 4 men. It is the most comprehensive financial regulation since the 1930s. The Act's preamble specifically references the Lehman failure. The Lehman Brothers bankruptcy estate, working through the courts for over 16 years, has returned over $128 billion to creditors by 2025. In March 2023, Silicon Valley Bank fails. The Federal Reserve, again, decides to backstop depositors. Signature Bank fails the same week. First Republic Bank follows in May. The institutional memory of Wall Street, it turns out, lasts about 15 years. The weekend of September 12th to 15th, 2008, was not about whether Lehman Brothers deserved to fail. It probably did. The weekend was about whether the Federal Reserve and the Treasury had the legal authority to save it. They did. The same authority was used, less than 36 hours later, to save AIG for $182 billion. The decision to let Lehman die was a political choice presented as a legal constraint. The decision to save AIG was a legal choice presented as a political necessity. Sources for tonight's episode are linked in the description, including the full 9-volume Valukas report, the Financial Crisis Inquiry Commission final report, the Federal Reserve press releases from September 16, 2008, and the memoirs of all 4 men in the room at 33 Liberty Street. Internal dialogue is reconstructed from those sources, from court testimony and from journalist interviews. Where the record was silent, this script remained silent with it. The 13th floor of 33 Liberty Street is still there.